Open your email right now and check your last car insurance renewal notice. If you're like most Americans, the number on that page went up significantly, somewhere between 20 and 50% in the past 2 years. Some people have seen their rates double. You haven't been in an accident. You haven't gotten a speeding ticket. Your car is a year older, which should technically make it cheaper to insure. And yet your premium just jumped by hundreds of dollars a year. You're not imagining this. You're not being singled out. And it's not because of your driving record. The real reasons your car insurance costs so much right now involve technology that was supposed to make cars safer, a legal industry that's spending billions to make accidents more expensive, a climate that's destroying more vehicles than ever, and an insurance business model that's far more complicated than most people realize. By the end of this video, you'll understand exactly why your bill went up, who's profiting from it, and what, if anything, you can actually do about it. Let's start with the most counterintuitive reason of all. Here's a fact that surprises most people. The average cost to repair a vehicle after an accident has increased roughly 40% in the past 5 years. Not because mechanics are charging more, because the cars themselves have become vastly more complex. A typical fender bender in 2015 might have damaged a bumper cover, maybe a headlight, and possibly some sheet metal. The repair cost for a Honda Civic or Toyota Camry was roughly $2,000 to $3,000. That same fender bender in a 2025 model year vehicle looks very different. Today's bumpers contain radar sensors for adaptive cruise control. Headlights contain LED arrays with integrated computer modules. Side mirrors house cameras for blind spot monitoring. Windshields have embedded heating elements and heads-up display projectors. Even the paint contains special coatings that require multi-stage refinishing processes. A cracked front bumper on a modern vehicle doesn't just need bodywork, it needs sensor recalibration, a process where specialized equipment re-aims the radar and camera systems to ensure the safety features work correctly. This recalibration alone can cost $1,000 to $2,000 on top of the physical repair. The result is that a $2,500 fender bender repair from 2015 is now a $5,000 to $8,000 repair on a comparable 2025 vehicle. The car is safer to drive, but exponentially more expensive to fix. And then there's electric vehicles. An EV battery pack typically costs between $8,000 and $65,000 to replace depending on the vehicle. If a battery is damaged in an accident, even minor structural damage to the underside of the car, the entire pack may need replacement. Some insurers have reported total losses on EVs with relatively minor physical damage simply because the battery replacement cost exceeds the value threshold. This means insurance companies are paying out dramatically more per claim than they were even a few years ago, and those higher payouts get passed directly to you in the form of higher premiums. Every policyholder shares the cost of the system getting more expensive, regardless of whether they personally drive a tech-laden vehicle. The second factor driving insurance costs is less obvious but enormously impactful. The cost of injury claims and lawsuits has surged. The average auto liability claim involving injuries has nearly doubled over the past decade. Part of this is medical cost inflation. Emergency room visits, surgeries, and rehabilitation are all significantly more expensive than they were 10 years ago. If someone is injured in an accident, the medical bills that the insurance company has to cover are substantially higher than they used to be. But a larger driver is what the insurance industry calls social inflation, the tendency of juries to award increasingly large settlements in personal injury cases. Jury awards in auto accident cases have grown dramatically, with verdicts exceeding $1 million becoming far more common than they were a decade ago. This is closely connected to the explosion in trial lawyer advertising. The legal industry spends over $1 billion per year on television advertising alone. Those injured in an accident? Call Us Now commercials that run constantly during daytime television. Digital advertising adds billions more. This advertising is effective. It increases the number of people who file claims after accidents, the number who hire attorneys rather than settling directly with insurance companies, and the size of the eventual payouts. When more claims are filed, with more attorneys involved, seeking larger settlements, the cost to the insurance system increases substantially. And once again, those costs are distributed across all policyholders through higher premiums. There's an important nuance here. Many of these claims are legitimate. People who are injured in accidents deserve fair compensation. The issue isn't that people are suing, it's that the total cost of the system has increased dramatically, and that cost has to come from somewhere. It comes from your premium. Most people don't know this, but in most states, your car insurance premium is partially determined by your credit score, or more precisely, by an insurance score derived from your credit history. Insurance companies discovered decades ago that there's a statistical correlation between credit behavior and the likelihood of filing insurance claims. People with lower credit scores tend to file more claims, statistically speaking. The reasons are debated. Some argue it's because financial stress correlates with other risk factors. Others argue the correlation is coincidental or reflects socioeconomic bias. Regardless of the reason, insurance companies in most states legally use credit-based insurance scores as a pricing factor. This means that if your credit score decreased, perhaps because you carried a higher balance during a period of inflation, or missed a payment during an economic downturn, your insurance rate could increase even if your driving record is spotless. This is one of the most controversial aspects of auto insurance pricing because it means your premium is determined not just by how you drive, but by your overall financial behavior. And most consumers don't realize this connection exists until they see an unexplained rate increase and start investigating. Some states have banned or restricted the use of credit scores in insurance pricing: California, Hawaii, Massachusetts, and a handful of others. But in the majority of states, your credit history is actively factoring into what you pay for car insurance. The third major factor is one that would have seemed almost absurd 20 years ago as a driver of car insurance costs: weather. Natural catastrophe losses for the auto insurance industry have increased significantly over the past decade. Hailstorms alone cause billions of dollars in vehicle damage annually. A single severe hailstorm can damage thousands of vehicles in a metropolitan area in minutes. The frequency and intensity of these storms has been increasing. Flooding has become a major vehicle loss driver. When a car is submerged, even partially, the electrical systems, upholstery, and mechanical components can be damaged beyond economical repair. The vehicles destroyed by hurricanes, regional flooding events, and other weather events have added billions to insurance company payouts. Wildfires have destroyed thousands of vehicles. Extreme heat has damaged batteries and tires. Even the increasing frequency of severe thunderstorms with high winds creates more comprehensive claims from fallen trees and flying debris. What makes this particularly challenging for insurance companies is that their pricing models, called actuarial models, are built on historical data. They calculate your premium based on how much they expect to pay out in claims, using decades of historical loss data. But when weather patterns change faster than the models can adjust, the companies find themselves consistently underpricing risk. They charge too little, pay out too much, and then have to raise rates dramatically to catch up. This is what's been happening across the industry for the past several years. A catch-up period where rates are being adjusted upward to reflect a new reality of higher weather-related losses that the old models didn't predict. Here's where the business model gets interesting. Most people assume that insurance companies make money by charging you more in premiums than they pay out in claims. That's partially true, but it's not the whole story. And sometimes it's not even the main story. Insurance companies take in premiums from millions of customers. They then invest that money, primarily in bonds, stocks, and real estate, before they need to pay it out in claims. The period between collecting a premium and paying a claim is called the float. Warren Buffett has famously described insurance float as the foundation of Berkshire Hathaway's investment empire. Buffett's insurance companies, GEICO, General Ray, and others, collect billions in premiums, invest that money, earn returns, and then pay claims. Even if the insurance operation itself breaks even or loses a small amount on the underwriting side, the investment income generated by the float can be enormously profitable. This means that insurance companies have two ways to make money: underwriting profit, which is collecting more in premiums than they pay in claims and expenses, and investment income, which is earning returns on the float. In years when claims are high, like recent years with expensive repairs, larger lawsuits, and weather losses, insurance companies may actually lose money on the underwriting side. But if investment returns are strong enough, the overall company can still be highly profitable. This dual income structure is why the industry can simultaneously report that it's struggling with high claims costs, while also generating record overall profits. Both things can be true at the same time, and both things influence your premium. In recent years, the property and casualty insurance industry generated strong overall profits. Some estimates put the figure above $22 billion, even as it raised rates aggressively. The rate increases were genuinely needed to address underwriting losses. But the overall profitability of the industry means the companies aren't exactly hurting. Beyond the macro factors driving rates up for everyone, individual pricing varies dramatically based on factors that many drivers find surprising. Your location matters enormously. Urban drivers pay significantly more than rural drivers because urban areas have more accidents, more theft, and more expensive repair facilities. But even within cities, your specific zip code matters. Insurance companies use granular geographic data to price risk, and two neighborhoods a mile apart can have meaningfully different rates. Your age and gender still matter. Young male drivers pay the highest rates in the industry because, statistically, they file the most claims. This differential decreases with age but doesn't fully equalize until the mid-20s or later. Your vehicle matters, but not always in the way you'd expect. Sports cars are expensive to insure, obviously, but certain ordinary vehicles also carry high premiums because they're popular with demographics that tend to file more claims, or because those specific models have proven more expensive to repair than their price point would suggest. Even your occupation and education level may factor into your premium in some states, because insurance companies have found statistical correlations between these factors and claim frequency. The result is a pricing system that feels intensely personal. You open your renewal and see a number that seems arbitrary. But behind that number is a complex algorithm weighing dozens of variables, most of which you had no idea were being considered. The good news is that while you can't control the macro factors driving rates up, there are practical steps that can reduce your individual premium. Shopping around is the single most effective strategy. Insurance companies use different algorithms and weight factors differently, which means the cheapest insurer for your neighbor may not be the cheapest for you. Getting quotes from 5 to 7 companies, which can be done in under an hour through comparison websites, routinely saves drivers 20 to 40%. Bundling policies, combining auto with home or renter's insurance, typically provides a 10 to 25% discount. Insurance companies value customers who consolidate their policies because those customers are less likely to switch. Increasing your deductible from $500 to $1,000 can reduce your premium by 15 to 25%. This means you'll pay more out of pocket if you have a minor accident, but the monthly savings can be substantial. For drivers who rarely file claims, this trade-off usually makes financial sense. Asking about usage-based insurance programs, where you install an app or device that monitors your driving behavior, can earn significant discounts for safe drivers. These programs typically track hard braking, rapid acceleration, and nighttime driving. If your habits are genuinely safe, discounts of 10 to 30% are common. Maintaining your credit score, even though it feels unrelated to driving, directly impacts your insurance premium in most states. Paying bills on time and keeping credit utilization low can save you money not just on interest rates, but on insurance as well. And finally, reviewing your coverage annually makes sense. If your car has depreciated significantly, the gap between your premium and what the insurance company would actually pay in a total loss may have widened. Adjusting your coverage to match the current value of your vehicle can save money without creating meaningful risk. That's the profit equation behind your car insurance bill. Modern cars that cost 3 times more to fix. A legal system that's generating larger and more frequent payouts. Weather that's destroying more vehicles than actuarial models predicted. A credit score you didn't know mattered. And an industry business model where investment income means companies can raise your rates and still post record profits. Your driving didn't get worse. Everything around your driving got more expensive. And now you know exactly why. Subscribe for more business breakdowns every Tuesday and Friday. Free weekly analysis at the link in the description.